Hi, this is Kyle Ferguson with OptionSherpa.com, and today on this SherpaCast, I'm going to go over how to use the covered call calculator on our website. So the first thing that you're going to do, if you're not already in the calculator, is you're going to jump up to Basecamp, and you're going to scroll down to Sherpa Tools and the covered call calculator. So once you click on that, this page will come up, and you'll see that you can change to the different calculators that we have, or just stay on this current one. So the first thing that you're going to do is you're going to enter the stock symbol that you want to analyze in this calculator. Now, this calculator auto-populates everything down below it, which makes it really snazzy. You don't have to look up stock prices or option prices or anything like most of the calculators out there. It'll go grab it for you. So what you do is we're going to look at Barrick's Gold. So we'll enter in the ticker for Barrick's Gold right now. Number of shares, I will use 100 for simplicity, but you can change that to any number of shares that you have in your portfolio. Press calculate, and you'll see it auto-populates everything down here. Now, one thing that you'll need to take note of is this expiration date. The way that we trade, we're always looking pretty much at the closest expiration date, but this is a Friday morning. This expiration date is tomorrow. It's the 21st today, so all these options expire tomorrow. That's a little too close for us, so make sure that you change this first to the 28th, 1 week out for us. That's the only expiration date left in February. And once you do that, you can see that it already automatically changes everything for you. So the different categories and cells that we put in here are the stock price is auto-populated. It automatically grabs the closest strike price because that's typically what we trade, but you can use the drop-down menu and you can change that to any strike price that you want. It will only bring up strikes that have any decent premium in them at all. So it's not going to throw up the 25 strikes right now because there's no premium in them. But these 4 strikes have good premium for ABX, so that's what it will bring up for next week's expiration. It throws in the option premium that you'll receive for that particular trade, and then obviously the dates that you can change to different Fridays or Saturdays in the month, and then obviously any of the months that are currently populated on the option chain right now at the CBOE. So the next part of this is the income and return projections. The income on the trade that you will get if we did this trade right now would be $45, which is nothing more than 45-cent call premium times 100 shares. The return on the trade for the next 7 days is 2.14. You annualize that 2.14 out over the year, and that's 111%. Now that's a big return, and we'll get into that in other SherpaCasts. But as you plug in these trades from Option Sherpa portfolios or your own individual trades, you'll see how this works, and you'll see the amount of the advantage that it gives us to be in these stocks for long periods of time. So it's a really important number, and you'll see it work over time as you continuously do the Option Sherpa trades. The break-even point right here is what we have there is just kind of the current stock price, 20.98, minus what we're receiving, because we get that 45 cents in our account no matter what we do. And so as long as the stock stays above 20.53, we will make money. The maximum profit on the trade, not as extremely as important on this particular one I entered in because there's only 2 cents upside between these two. But what that is that's your $45 option premium that you're taking in, plus if you got this extra 2 cents in your if the stock went up 2 cents. So really what that's saying is max profit, or what's the ideal case scenario. Well, the ideal case scenario in this trade is if your stock closed next Friday at $21. You'd get the maximum appreciation in your stock, plus you'd realize your entire call premium. So that's the best case scenario. The risk management part of this is just kind of a what if part of the calculator. What if it jumps down 5%? What if it goes up 5%? This just kind of gives you an idea of, maybe we look at this a lot when earnings are coming out. What if these things jump 10% on us? What's it going to do? It's really important to kind of know, worst case and best case scenarios of all these trades that you put in. So this calculator lets you do that. Let's just kind of look at some of the cells here. It'll change the stock price, how much you make or lose on the stock at these different percent levels, how your call value reacts. You'll see that these are all 0. Well, if the stock goes down, your call will go to 0, which is ideal. If it goes up a little bit, it will increase in value, but not nearly as much as what the stock is, so we'll make it on the upside as well. The other part of this is the different profit and losses for the call, overall trade, and then obviously our percent return on the entire trade, including the covered call that we wrote and the appreciation or loss in the stock. So one thing to point out real quick is if the stock goes nowhere, 0%, we're going to realize 2.14% on this trade. If it increases big throughout this 7-day period, we'll max out at 2.24%. Now, a lot of people don't like that about covered calls because you cap your returns. Well, the way we look at it and the way we love doing covered calls this way is because that's 2.14% that we're getting every single week. So if the stock does jump up 10%, yeah, we only made 2.24 for this week, but we're doing this every single week. So in the long run, we're going to make up for that. And that's kind of the power of the strategy. It gives us the ability to still participate in the upside, but also provide great protection on the downside. So you can see here, if the stock drops 2.5%, we're only going to lose 0.36. If it drops 5%, we're only going to lose 2.86. So we're providing that downside protection every single week and also allowing ourselves to participate in the upside. So that's kind of the different parts of the calculator. Feel free, to play with these. You can jump these out to, maybe March and kind of see what the different expiration dates look like, the different returns. This changes really quickly. You don't have to wait for it to load or anything. This is on March expiration, which a lot of people can trade the monthlies versus the weeklies if they don't have time to trade each week. You can still see you're getting a great return. This is a decent premium, but that's why we have ABX in our portfolio. Is not only has it made 20% since we bought it this year, but it has great option premiums. And that's kind of the idea behind how we put these portfolios together. So that's a little short tutorial on how to use these covered call calculators. If you guys have any questions, go to optionsherpa.com and send me an email, and I will answer anything that I can. So that's it. Have a great day, and good luck trading.